4 pillars of an investment decision. These 4 pillars are the foundation of any investment project, any tool, and they are in fact the foundation of finance itself. These are: number 1, time value of money; number 2, inflation; number 3, interest rate; and number 4, cost of capital. Money received today is worth more than money received tomorrow. If I were to give you rupees 1 lakh now versus rupees 1 lakh after 1 year, all of you would prefer now. Why is that? Because if you take the money now and deposit in a bank FD for 1 year, the bank will pay you 5% interest for 1 year, and you will then grow your money to rupees 1,05,000. But if you decide to take the money from me after 1 year, then you will receive only 1 lakh rupees. Hence, rupees 1 lakh received today is worth more than if received after 1 year, since money received now has the possibility of earning 5% interest in 1 year's time. This concept is called time value of money, and in this example, the value of it is 5,000 rupees. Now, why is this important? In your investment project, you will receive or pay money at different points of time. The nearer they are to the start date, the more they are worth, and this is an important concept. Number 2, inflation. Inflation is the rate at which the general level of prices for goods and services rises, and consequently the purchasing power of currency falls. Now, I am going to give you an example to help you understand it in a very simple way. In year 2000, 100 rupees could buy you 7 liters of Amul milk, which had a price of rupees 14 per liter at that time. The same 100 rupees in the year 2010 would buy you only 4 liters of Amul milk, which had a price of rupees 25 per liter at that time. The same 100 rupees in the year 2020 would buy you only 2 liters of Amul milk, which now has a price of rupees 50 per liter. So, what does this demonstrate? It shows that the price of Amul milk has steadily gone up over the last 20 years from rupees 14 per liter to rupees 50 per liter. Consequently, the value of your 100 rupees has reduced over the same period. Why is this important? In your investment project, you will need to evaluate the impact of inflation. For example, in transportation project, cost of diesel going up, or in a factory, cost of raw materials going up, or in an office, cost of salaries going up. The third pillar is the interest rate. Interest rate is the cost of borrowing money and is expressed as a percentage of the loan amount. Cost of capital is the cost of funds used to finance your project. Now, to finance your project, your company would have raised money from either equity from shareholders or a loan from lenders. Both these sources of money come at a cost. The providers of equity funds take a risk, since they do not get any security for their money provided to your company, and hence expect a higher return on their money. This is called dividend. Providers of loans take a lower risk, since they usually receive some sort of security for their money. Hence, they normally receive a lower return on the money. This is called interest. A weighted average cost of the two sources combined gives what is called the cost of capital. In finance terms, it is called the weighted average cost of capital, or WACC.